And welcome to the Aaron Katzman Show. I'm your host, Aaron Katzman. We speak to your life, your money, and your investments. And as always, we're coming to the spiritual and soon to be financial capital of the world, Jerusalem, Israel. If you like this content, please hit the like button below. If you've not yet done so, please subscribe to both the YouTube channel and to the podcast. And if you think somebody's actually going to get something from this or it might benefit them in some way, go ahead and hit the share button below as well. So if you look behind me, you don't see any snow. That has been the question that has been on the minds of Jerusalemites for the last, I don't know, week and a half or so. Is it going to snow or not? Is it going to snow or not? And everybody's talking about it and it's freezing cold, but there's no snow and maybe there will be snow. Thomas Sowell once said, and I quote, "Would you bet your paycheck on a weather forecast for tomorrow? If not, then why should this country bet billions on global warming predictions that have even less foundation?" Right? The question of snow in Jerusalem has been front and center for residents of the capital for more than a week. Right? It's on TV and they're the local weather blogs. Everybody's talking about it. Is it going to snow? How much? And at the end of the day, fizzle. Nothing. I counted 74 flakes that actually fell from the sky. Oh, I think then I'm looking behind myself. I think there's another one that came now. We're up to 75 flakes in this massive snowstorm. Writing about the difficulty in predicting snow, Clay Mallett, who's a meteorologist of Snowbrains, writes, "Snowfall is a puzzle in the forecasting world, with every piece tangled in complex atmospheric dynamics, chaotic patterns, and ever-shifting terrain influences. Predicting snow isn't like projecting temperatures or wind speeds. It requires pinpointing two crucial variables, precipitation and temperature. Chaos theory helps us understand why this is so challenging. In a chaotic system like the atmosphere, tiny shifts in conditions can drastically alter the weather days later. A small fluctuation can turn a forecasted mild winter day into a snowstorm in just a few hours. This unpredictable behavior can make it feel like the atmosphere has a mind of its own." And like Thomas Sowell, I ask, and I actually tell this to my kids all the time, like, because they obviously, education day, they get brainwashed about global warming and climate change, whatever the term of the week is. I said to my children, next time they start telling you that in 50 years from now or 100 years from now, the seas are going to be rising and the polar bears are going to be drowning and the earth is going to be on fire, just tell them, we don't know if it's going to snow in 2 days from now. And you're telling me that you're going to tell me what the weather is going to be like in a century from now? Seriously? Okay, calm down. I'm now finished my rant about climate change and global warming. But how do I connect this to the topic that we speak about, which is personal finance? Recently, I've spoken to a few prospective clients who told me that they have money to invest, but want to wait because they believe the quote unquote, the market is high. This is actually something I hear all the time, especially after market drops. And then I speak to clients about maybe invest some of the money that they've had on the sideline sitting around in cash. I'll get the response like, I have a bad feeling about the market. Or I want to make sure that the market is going up before I invest. This leads to an issue that I've mentioned here numerous times, and that's that investors who try to predict the future or who try to quote unquote time the market usually end up with much lower returns than investors who stay the course and are fully invested. You know why? Because you can't predict the future in the stock market either, but that's just the way it is. And I know I'm going to throw it in now. Past performance is no indication of future market performance. Okay, regulators, check that off. Okay. Mark Daner of Daner Wealth Management writes, one study looked at the track record of stock market experts, quote unquote, who predicted the market's direction. Their findings were eye-popping. Overall, their accuracy was only 47%. Less than you might expect from random chance. He continues, over 20 years, from 2002 to 2021, another report found that the average difference between target price estimates from stock market experts at the beginning of the year and the actual prices of the index for the same year was a staggering 8.3%. And that's the experts, just like the weather experts can't tell you what's going to happen tomorrow in the weather. As I mentioned previously, right, Humphrey Thomas, who's the CEO of H.G. Thomas Wealth Management, wrote it on CNBC, and he said, longer-term approaches are a better strategy. JP Morgan compiled some research showing the importance of this. They tracked the performance of a $10,000 investment in the S&P 500 over a 20-year period. It showed a healthy average return of 9.85%. But they modeled that what would have happened if the investor withdrew from the market temporarily and missed the 10 biggest days on the stock market for that 20-year period. Just 10 days out of 7,304 days, okay? That's 10 days out of 20 years. The result was a reduced return from 9.85% to 6.1%, which means a decrease of, in this case, $32,665 in gains. And the more days missed, obviously, the lower the gains fell. It just goes to show, right? It's just the evidence is overwhelming. Thomas continues and brings an incredible stat. Nobel Prize winner William Sharpe, the famous William Sharpe, found that market timers might be right an incredible 82% of the time just to match the returns realized by buy and hold investors, meaning it's virtually impossible, right? You can't always be right. You're not going to be right 82% of the time when we just saw that only on average 47% of the people are actually accurate and able to predict. The 82% hit rate is virtually impossible to accomplish. If most professionals can't even come close to that kind of success rate, then a retail investor has almost zero chance, okay? You might be right once or twice, and that usually happens right at the beginning. That's just Murphy's Law, right? You're gonna think you're a market genius. You're the next Warren Buffett, and then things start going the other direction fast. So don't count on that continuing because all the data says it's not going to continue. Just like the weathermen can't predict what the weather will be, market timers can't continuously predict the direction of the stock market. The tried and tested way to make money in the stock market over the long term is to be invested in the market for the long term. Okay? I'm not a big fan of cliches, right? But the famous cliche of it's time in the market, not trying to time the market, is your path to success. Okay? Even more important, before you start investing, before you pull the trigger on your first investment, figure out what your goals and your needs are, and then create a portfolio that will enable you to achieve whatever it is that you're setting out to try to accomplish financially. Allocate the money accordingly, and that's going to help you manage risk and ease the market roller coaster, right? Smooths out the ride a little bit. It's not quite as volatile. That's a much better formula for success than trying to predict the future. You've been tuning into the Aaron Katzman Show. We speak about your life, your money, and your investments. If you like this content, please hit the like button below. If you've not yet done so, please subscribe to the YouTube channel and to the podcast. Thanks so much for tuning in, and we'll speak to you soon.